So today I wanted to show a little bit of my investing strategies and the tools that I use that I've been using for investing in my current dividend portfolio over at M1 Finance. And just as a precursor, everything that I'm about to talk about, this is my own personal investing philosophy. This is my own risk tolerance and what's important to me and what's important as well as to us as a family. No way am I telling you what you should buy, what you shouldn't buy, and in no way am I also advocating that you should ever substitute my opinion for your own. Now, that being said, the overall investment strategy or end game of this particular portfolio is to provide income, and that's going to be providing income in the form of dividends from dividend-paying stocks. This is a website called dripinvesting.or, and they have this really cool website that basically just shows you what they call dividend champions, contenders, and challengers. And really just champions are companies that have raised their dividend consistently every year for the last 25 years. Contenders have done the same thing for the last 10 years, and challengers for the last 5 years. And it's a really good resource to get an idea of what companies are really doing pretty well. And here's a little spreadsheet. You click on this, you download it, and this is what it actually looks like. It's this little spreadsheet, and it gives you a list of all of these dividend champions and contenders and everything like that. It's a really good resource. And what I like to do is go down here to this all CCC, that's champions, contenders, and everyone. And at first it's pretty intimidating when you first open it up, but it's actually pretty straightforward. Over here we have a list of all the companies, we have the ticker symbols, there's the dividend years over here, or how many years they've been raising dividends, as well as the dividend yield. So what I like to do is click right above here and then come up here and add a filter and then scroll back and fix it. This allows me to filter through a bunch of different things to make sense of everything. And the first thing what I'm going to do is take a look at this, the number of years right up in here. This is the number of years that these companies have been raising their dividends. And I'm going to filter it. I want years greater than or equal to, and I'm going to put in 15. So this means these are companies that have been raising their dividend yield for the last 15 years, which means it's been past the 2008 recession consistently. I'm also going to look on the dividend yield, and I'm going to do the same thing as before. And I'm going to go greater than or equal to, and I like 3% dividend yield. And then after that, I'm going to go ahead and click over here. And then finally, so right now I have all these companies either have been raising their dividend yield for the last 15 years consistently, and they have a dividend yield of greater than 3%. I'm going to click on the sector right here, and let's take a look at the real estate section. It makes things a little bit easier to see. So going through here, what I would do is I'll just go in here and then just pick a company that I think looks relatively good. So for this particular situation, I'm going to take a look at Realty Income, all right, which is ticker symbol O. And I'll just go ahead and plug that in to this website, which is called Seeking Alpha. All right, so now I have Realty Income Corporation. I'm going to look under their dividends tab. And once this thing loads, and here we go. So they have a dividend yield of 5.41%, which is not too bad, and a pretty good, decent payout ratio. What I want to look at here is their dividend history. And this will give me a graphical overview of how they've been increasing their dividends. And when we do, I'll click on all, it shows me the entire time frame. And this is what I want to see. Consistent, reliable growth and increasing their dividends over time. All right, this is a really good indicator that this is a strong, healthy company. I'm going to look under the dividend growth, and this is their yearly payout. And it's basically the same story. They've been consistently, yearly increasing their dividends year after year. So this is something that's really good and really strong. Now, the next thing I'm going to look at is under their key data. This is their revenues. And you can see that their revenues are starting out at around $1 billion, and they're ending at around 1.5 billion, which means they're increasing their profits. They're making money. I'm looking at their operating expenses, which is around 500, and then ends at around 762, which is good. It means that they're spending money to make money. I like to see that. And then I'll scroll down here to the last bit, and this is their net income, which you can see it starts at around 300 or so, and then ends at around 470. So this is a strong company that's making profits and increasing. They're constantly making money and increasing their profits over the years. Looking at their balance sheet, this would be like their assets and their liabilities. I'm going to take a look at what I really want to see, first of all, is all of their regular assets they have down here. So if I scroll down here, I can see their total assets. You can see that it starts at around 11 billion and eventually makes it all the way up to around 16 billion. So they're increasing their assets. And if you're looking at their total liabilities, their liabilities are growing, but not as bad as their assets. So this is telling me that they're increasing their assets not as much, or quickly, more so than they're increasing their liabilities, which means their overall equity is growing as well. So again, that's a really good sign that this is a strong, stable company with good profit margins. The last thing I'm going to do is take a look at their actual website. And this tells me who they are, what their customers are, their clients are, and how they make their money and how they're able to pay everyone out. Let me actually take a look at their their actual portfolio. Let me see here. I can look at their top 20 tenants. And these are the companies that pay rent to realty. So you have companies like Walgreens and 7-Eleven, FedEx, some theaters, LA Fitness. And so these companies pay rent to realty income for the ability to use their buildings. And in turn, realty income pays us shareholders the actual dividends based off of the rent. So let's go ahead and do another example. I'm going to uncheck the real estate box, and let me take a look at. I want to take a look at a utilities company. So if we scroll down here, take a look at utilities. So now let's see. One of the things that looks interesting would be there it is. It's Dominion Energy right down here. D. So what I'll do is I'll put Dominion Energy into Seeking Alpha, and here's their dividend page. 4.76 yield, not too bad. All right, let's take a look at their dividend history right over here. And click on all. And again, consistent, reliable dividend growth, even during the last 15 years. If I click on growth, I can also see that they are, again, it's the same story, consistently increasing their annual dividend payouts over the years. This is what I really want to see. This tells me it's a good, profitable company. All right, next I'll go and click on key data, and let's take a look at their income. Let's see, so their total revenues, again, their total revenues are growing. So starting from around 11 billion, going up to 17 billion. That's what I want to see. And if I click or scroll down and look at their operating expenses are also going up. Bit of a jump in 2019, but not too bad. All right, again, I want to see that they're spending money to make money. All right, I don't want to see that they're laying a bunch of people off and their expenses are going down. And I look at their net income, and their net income has a little bit of a drop again in 2019, but it's not too bad. I'm not going to really fault them too much on that. Let's take a look at their balance sheet. And if we look under their total assets, that's generally where I want to first start looking, is under their total assets down here, which is growing, which is very nice. Let's see here. Oh, there it is. There's total assets. Huge jump in 2019, over 103 billion. Not too bad. And then, again, looking under their liabilities, their total liabilities, again, it's growing up, it's growing, but it's not too bad, which means they still have major equity within this company. And finally, I'm going to go to their webpage, and if I look under Dominion, they're a utilities company. They have customers and they pay utility bills and everything like that. But they are a renewable, sustainable energy company. So if I actually look under about them, so take a look here. Let me close this. But they focus on sustainable, clean energy. And this is where I see a lot of technology heading, especially with like electric cars now. A lot of electric cars now are almost entirely battery powered. So a lot of renewable energy and sustainable energy is kind of the new wave of the future. So I want to be invested in a utilities company that specializes in that type of energy production. Now I want to show an example of a company that I personally would not invest in, especially for dividends, and a company that doesn't really follow the kind of the guidelines that I've been laying out this entire video. And this would be Macy's. Now, the thing with Macy's is you can see that they have a very fat dividend yield of over 30%, which might be a little bit, interesting to, some folks, but it's a bit of a red flag, especially for dividend investors like myself. So if we were to take a look at their dividend history and get an idea of what's been going on, and click on all, and so this is a bit concerning. See this back in 2009 or whatever, they could not handle the recession. So that's a bit dangerous. If I click on their dividend growth, I'll probably see a similar story. And if I scroll down, yeah, a bit of a similar story. But the other issue is that for the last few years, what is it, from 2015? Looks like from about 2015. Yeah, they have, it's been $1.51 this entire time. They have not raised their dividends. And that's a bit concerning to me. All right, I don't want to see that. That's, what's going on. So if we take a look at their key data, and if we look under their total revenues, it starts out at 27 billion, then it goes down to 26, then to 25. The revenues are going down over the years, so they're actually losing money. If we scroll down to their operating expenses, they're right around 8 billion, right around 9 billion or so. Their operating expenses are staying the same. So this means that there's a bit of a problem if we were to look down on their net income, which is jumping all over the place. I mean, we're around 1 billion over here, then it goes down to 600, then back up, and then it's back down in 2019. So whatever it was they did to fix that problem, it went from 600 to 1 billion, it's whatever that problem is, it didn't fix it because they're back down now. So what's happening overall is their revenues are going down, but their expenses are staying the same, which means that their overall profits and their profit margins have been going down consistently over the last few years. But yet somehow they've been able to pay out nearly 30% in dividends to investors. So something's got to give. This cannot be maintained. I don't see this as a sustainable business model that can consistently be able to pay out dividends to investors. So now, don't substitute my opinion for your own, but this would be a reason why I am passing and not putting any money towards Macy's. And next week, I'll show you what's in our dividend portfolio and the companies that we're invested in, particularly for income, as well as the progress that it's been making, because I've made quite a few changes since the last time I've shown it on this channel. So with that being said, hope you all have a really great weekend. Stay safe, and I'll talk with you next week.